Good morning, Cleo.
Hey, good morning. How are you?
Welcome to the Dario Mambo Show. Thank you for being here.
Of course. Thank you for having me.
Yes, this is going to be exciting. I get to talk to a loan officer with a lot of experience in the business and someone I've actually worked with before in the past.
Awesome. Yes.
So who are you and what do you do?
Hey, so my name is Cleo Garza. I'm a loan officer with Summit Funding, and that's what I do. I love what I do.
What's a loan officer?
Loan officer in the mortgage industry is someone who originates a loan.
Originates loan, like, oh, so you're the banker? You give the money out?
We're the banker, yeah.
I see. What got you into this business?
You know, in my past life, I was in IT sales, and I called on a very large mortgage company at the time, and they had an interest in me in that they thought that I could work for them and sell mortgages or actually, you know, buy them, if you will. We were predominantly a secondary market mortgage bank, portfolio lender. It was World Savings.
Wow.
And that's where I got my career started in.
So you got recruited?
I got recruited, yeah.
You got recruited because
Yeah.
you must have had some good skills. What are some of the skills you need as a loan officer?
I think communication, number
Communication?
one. Yeah. The number one skill I think is communication for sure, and then the desire to really help people and
Right.
show up every day, and knowing that every day is going to be a different day. Every client's a snowflake. They're all different. They don't have the
Right.
same pattern.
Interesting. Yeah, everyone's different.
Yeah.
So let's talk about today's market. What's going on? We are in the third quarter of 2023, right? What are you seeing? How has the interest rates changed this year? How has the market changed this year from the perspective of a loan officer?
Okay, so your first question, how have rates changed this year?
Yeah.
Well, you know, they've gone up.
Yeah.
They're the highest they've been in quite some time.
Really?
Yes, and so, you know, that change in itself has really slowed the market down.
How so?
Well, with the higher interest rates, people were used to extremely low rates 18, 20 months ago, and that's just not the case right now.
What's the example of a low rate?
A low rate, I did mortgages in sub threes, you know,
And
24, 36 months ago.
And why is that? Like, I saw a grin on your face. Why is that special? Or like, why was that like a unicorn?
I never thought I'd see that in my career ever.
Wow.
Never.
So sub 3 interest rate on
Yep.
a 30-year fix.
Yep.
And so where are we at now, more or less?
Today we're in the sevens.
In the sevens.
Yeah, high sevens.
And so
mid-sevens.
how does interest rate affect ability for home ownership?
Well, the rates have increased, but the income from a prospective home buyer has not increased
Has
to the
not.
same level.
So how does the rate affect someone's ability to afford a home? Is
Well, they're going to get a higher payment,
Higher
obviously,
payment,
and so that affects their decision on whether they should buy or not.
so with the higher interest rate, someone may be kind of priced out of purchasing power?
Very much so. Yes.
And how was it in 2020 during COVID 2021?
Well, you know, those were great times. They were crazy times. People were refinancing, were trying to, you know, buy homes if they could, and it was one of those gifts we got from a pandemic.
Yeah. You mentioned refinancing. Did you see a lot of refinancing at that time?
Oh yeah, everybody that could refinance definitely did.
Why do you think people were refinancing like crazy back in 2020, 2021?
Well, because they were coming off of rates they had prior that were 4, 5, 6s, and it just made a lot of sense. They'd save a lot of money on interest. Maybe they changed their term and wanted to take advantage of lower payments.
So by refinancing to lower interest rates would reduce their monthly mortgage.
Of course, they're by increasing their cash flow in terms of what they could use that money for for disposable income,
Right.
pay other debts, buy other things.
So don't change house, and renovate, no forced appreciation, but just change the interest rate, and then you can save a lot of money.
Correct.
And then opposite effect of what's going on now, interest rates are higher, so people can afford less.
Correct.
Can we talk a little bit more about that? Like, where do you see the interest rates going? Are people scared in today's market? What's the state of the event?
Well, something interesting happened about 3 weeks ago. The U.S.'s credit rating was downgraded from AAA to AA+. the last time that happened in 2011, interestingly enough, that's what started the descent downward in long-term interest rates, mortgage rates. So, you know, the industry, you know, the industry insiders,
Yeah.
people really think that this is happening again.
Yeah.
So I'm hoping that with that unfortunate downgrade in the U.S., with the U.S. credit rating, that we're going to see the descent in rates over time, and hopefully by December, January, definitely I think if we're right,
Yeah.
and we've been wrong,
Yeah.
by January we'll see rates come down to something that's more attractive to the home buyer.
So I want to go back to that, but before this backtrack, give a little more clarity in case people don't know what the United States credit rating is and where it comes from.
The credit rating is based on our standing as a country and our credit rating, just like your FICO score.
Yeah.
Let's say you have a 740 FICO,
Yeah.
right? And but now you got a 700, just above 700. So it's U.S. debt is less attractive.
Oh, I see.
Okay, so
So in whole,
yes,
so if you look at the United States as a debtor or creditor, their credit score went down.
we just became a little riskier.
Oh, I see. So let's talk a little bit more about that. Is people's personal credit, important in their ability to buy a house?
It is important, absolutely. You know, a credit rating, I just mentioned 740. 740 really is the pinnacle, if you will, the very top. So if you have a 740 FICO or better, you'll get the absolute best market rate.
I see. So for people out there who are wondering what interest rate, what credit score they should shoot for, 740.
740, but it's not absolutely necessary
Yeah.
to have a 740 FICO. If you have a sub 700 or even above a 600, you know, you have an opportunity to buy a home.
So there's options for everyone.
Of course.
But what you're saying is with a higher credit score, you get better options for
Absolutely.
ratings. Oh, I see. So why not strive for a better credit
Why
score?
not strive, exactly.
So let's go back to the conversation about the inventory in the United States.
Sure.
Maybe we talk about like the county, Bexar County, and how interest rates and inventory, how do they play a role in the real estate market?
Okay, sure. So we obviously have an inventory issue here in San Antonio and, you know, nationwide.
By inventory, meaning like there's not enough houses?
Not enough houses, right. So a normal market is 6 months of inventory, right? That's where we think it's a healthy marketplace, where there's 6 months of inventory. Today, depending on who you ask, it's between 3.5 months inventory.
So
Okay.
within 3.5 months, all the houses on the market
Right.
should be selling.
Right. And so that's driven by the interest rates because, you know, there's people out there who own a home and they're maybe in a 3% range and they just
Yeah.
don't want to give it up.
Right.
And then if they sell that home, well, they're going to give up that rate and they're going to move on to buy a home and the rate is not going to be 3%.
Yeah. So a scenario, someone who's maybe ready to upgrade in their life, maybe the family's getting bigger and a bigger house. They've been in the house a few years. They have a great interest rate. If they sell the house and buy another house, they probably can get less of a house than they have now. Because of
Perhaps they won't be able to move up as high as they'd like to or pay a larger payment to
Right.
make that move.
to make that move, right? Yeah. So a lot of sellers are hesitating to make
Absolutely.
that move.
Right.
What about the buyer side? Like a lot of buyers hesitating right now?
Some buyers are hesitating. I think I read something the other day where the vast majority of the home buyers today it's somewhere in the high 40% of all home buyers are first-time home buyers.
Wow.
Yeah. And so, you know, they're coming to the marketplace looking to buy a home. And obviously their option is to either rent or buy a home.
Yeah.
And rates are affecting their decision.
Yeah. You think they're intimidating their decision, or is it stopping them from being able to buy a home?
Intimidation, for sure, because the rate seems, you know, very high, which historically, it's not very high. You know, it's above where we'd like for it to be.
Right.
But my first home that I bought in 1990 was 9.875.
Wow.
And before that, in the 80s, they were in the teens.
Yeah.
So there's a significant difference in that and 7%, 7.5%, or whatever it is today.
Yeah. What's the relationship between, like someone who wants to buy a house now but doesn't want to get into the high interest rate versus someone who wants to buy later when interest rates are lower, but then you have another challenge that's like overpaying for houses and a lot more competition.
Sure. So let's go back to a comment you made about the COVID years, if you will.
Yeah.
So that's what brought us very, very low interest rates. And at the time, we still did not have an abundant supply of homes in the market.
So it's still like a seller's market back
Yeah.
then.
And so when someone was buying a home, if you recall, if a home was selling for $300,000, $400,000, you were seeing offers way above ask, 5-10% above ask, and people were getting that.
Yeah.
Okay. So fast forward, and that was driven by the low interest rates. A lot of people got into the market to buy a home.
Yeah.
And
a lot of players.
Yeah. And so they came in and they bought that home, but in some cases they overpaid or paid very top of market.
Yeah.
Right. Whereas today, that's not happening.
Right.
You have sellers who are more willing to give seller paid contributions, seller credit, lowering the price, and so that's affecting, of course, the home buyer.
Yeah.
And it's affecting the absorption rate. Right. That's why we still have, like we just talked about, 3.5 months of inventory.
Yeah. Wow. So by people having lower interest rates, they were able to maybe afford on paper houses that maybe they weren't ready for.
They're out of reach, yeah.
And then because so many people were bidding for one house, the person who really wanted the house had to overbid. And so what are we seeing in today's market, third quarter of 23?
What we're seeing in today's market is, from a buyer standpoint, although they can afford, perhaps less home, you can buy a home today and not be faced with the pressure of having to be in multiple offer situation. Although I still see that every now and again, depending on the price point.
Right.
But a first-time home buyer today can, make a fair offer on their home, and they'll get a combination of one of the two, or one of the two is a lower price perhaps, or the seller willing to give seller-paid contribution to cover some of their closing costs to perhaps buy the rate down and make that purchase more attractive for that buyer.
Nice. What are some of the pros and cons of buying a house today?
The pros today are huge. That's what I think is exciting, and not enough people are talking about it.
So let's talk about it. What's a big pro?
Well, the big pro today is that if you are buying a home, aside from the one negative, the higher interest rates,
right,
you're going to buy a home at a fair price, okay? And you're not going to have to overpay, because we predict that when rates get somewhere in the 6 range or just below 6, it's going to create a buying frenzy, and you're going to be paying above ask again, but not having the benefit of that low interest rate that we had 2 years ago. So in essence, if you buy today, yes, maybe you'll have a $200 difference in mortgage payment, but you're going to pay 5 or 10% more on that home.
Yeah.
So if the home you're buying was $300,000, let's say $400,000, you're going to pay 20, 40 grand more, again, because we have not fixed the inventory issue.
Wow. So you're saying if you're comfortable with a higher interest rate, then you're in a better space to negotiate for a better price on a home.
Better price, or concessions from the seller.
Concessions from seller, right? Right. And then in turn, like if you were to buy when your interest is lower, you have to pay more. But actually, when you look at the amortization schedule of a mortgage, you actually not only pay 15%, 20% more to get the house. You end up paying a lot more over the course of 30 years, right?
I mean, let's just say that the difference in payment was $300.
Yeah.
Okay, $300. In 12 months, you're going to pay $3,600 more in that 1 year.
That 1 year.
But you're going to pay $30,000 more, $40,000 more for that house.
You're right.
When you can just refinance at that time.
Yeah. Interesting. Right?
That just makes good sense.
So what are the cons now of buying a house in today's market?
The con is that you're going to pay a slightly higher rate for a short period of time. That's the only con.
Now, would that affect someone's ability to buy the house that they want? I want a 4-bedroom, 3-bathroom house, 2,700 square feet, in a nice neighborhood, subdivision, but something like that, for example, and then someone's interest rate can affect their ability of maybe buying the house they want because of $200-$300 more can make a difference in their debt to income.
Yes. Yeah.
So can we talk a little bit about how debt to income affects debt to income? What's that relationship between debt to income and like interest rates and your ability to afford a mortgage?
Right. So your first question was, what the effects would be for somebody who's buying a home today with the high interest rate.
Yeah.
Yes, they may not get to the home that they want, but the argument is still, if you can find a home that that meets 75% of your criteria, buy it for 2-3 years. A first-time home buyer won't be in their house more than 3 to 7 years.
Right.
That's what we're seeing
historically, right?
And then in 3 years, sell your house, take that profit, and move up to what you really want. And go back to your question, the second one.
The relationship between interest rates
right.
and then the debt to income and then your ability to have purchasing power.
Right. So your debt to income ratio, it's we call it DTI. Debt to income ratio. It's what you bring in terms of income, what goes out in terms of debt obligations.
Now, what's a debt obligation that a mortgage loan officer would consider? Like credit card, phone bill, I owe money to my mom, like what kind of debt are we looking for?
It's whatever appears on a credit report and what we discover as a lender.
So if something's not on my credit report, like electric bill, water bill.
We don't count that. We don't look at that.
So only the debt that comes from a credit report.
Correct.
In relation to your income.
Correct. Or if there's an outlier like you pay child support or spousal maintenance, things like that we don't know about. But typically, that's discovered, in the loan application process. But basically, it's really what we see on the credit report.
On the credit report, and then what's that relation? Like, where do you suggest a home buyer be as far as their debt and their income ratio?
A healthy DTI is somewhere in the 30s.
30%.
Right.
So 30% of the income is the debt.
Right.
Why is that a good rule?
That's just something that's been around for a long time. In a perfect world, the consumer today wouldn't have a ton of debt, and so they could afford a home that they really want and make the payments comfortably.
Yeah.
So, it varies per person because the DTI could be, at a certain level based on what we know. And let's just say, for example, just one spouse is applying for the loan in their name only. We're not counting the income from their spouse who's just a non-borrowing occupant. Okay,
because only one person would be on that loan, right?
Correct. But the DTI, it depends on the credit score, the income, and the loan program as well. It's kind of all over the board based on just the program and what's tolerated from a DTI standpoint.
Wow. So from the perspective of a loan officer, what are some of the things, what's a checklist that you have whenever you're talking to a new home buyer that's considering buying a home? Like, what's a checklist that you need in order to say, okay, now you're ready. Now you have what's called a pre-approval or a qualification letter. Like, what's that process like?
So really the list is pretty much the same for any home buyer. We'll start off with some basic things like, W-2s, pay stubs, bank statements, things of that nature, right? If they're self-employed, we're going to want to see their tax returns, personal and business, depending on how their income is structured. If you're a veteran, the list is a little bigger. You will need a couple more documents from them.
Really?
Yeah. But the list is pretty much the same, but it depends on the transaction as well. But we send out a needs list that's catered to whether you're a first-time home buyer or just a must move up.
Yeah.
And you still have a home, then we're going to ask you for some other things if you're going to keep your home or not. Or if you don't have a home and you're just going to buy a home and you're both W-2 employees or the buyer is just a W-2 employee, that's a very simple, basic list.
Wow.
But to get back to what you were saying, my preference is to get all that information up front.
Yeah.
Okay, put it in the file and submit it as a TBD and actually have it underwritten so that we're just not pre-qualified. We're not pre-approved, but we're approved.
What's the difference?
Pre-qualified is you've given me some basic information.
Yeah.
Filled out the application online, or we did it over the phone. I got a snapshot of your credit report. Done the quick math, and I can just say, hey, based on what you shared with me and your credit score, you're pre-qualified to X, right?
So you're qualified.
You're qualified, right?
Oh, I see.
So you go from pre-qualified to pre-approved when we validate that information.
Oh, I see.
Verification of employment.
So
income.
the difference between a qualification and approval is validating of the information.
Absolutely. Huh?
Wow. Interesting.
But we can also get a client to an approval status without having a contract. And so if we have enough information to submit it, we call it as a TBD, just to be determined.
Yeah.
And I have a client right now, and we've submitted them through underwriting as a TBD based on a certain price point, and we submitted it. We already have an approval from underwriting, so they went under contract 2 days ago, and all we need is a receipted contract,
Yes.
appraisal, and title.
And they've already done the conditions?
Yep,
Wow. So they've already gone through like an underwriter?
absolutely.
Wow. And that's a pre-approval.
That's they're approved.
Yeah.
We had an approval.
Yeah.
You know,
So why don't most home buyers get that through that process? Because what happens compared to someone with a pre-qualification who is pre-qualified, go out shopping, make an offer on a home, they get really excited, then they go into underwriting. And what are some of the pitfalls of underwriting, or what are some of the common mishaps that happen in underwriting?
well, hopefully, if they visit with me, they're not going to have any pitfalls.
Yeah, good.
But in some cases, you know, we do have there's buyers out there who get pre-qualified and make an offer very quickly, and that's okay if we have a good sense of who they are as a buyer.
Yeah.
Great scores. We know we have assets.
Yeah.
Got a pay stub, maybe a W-2.
Yeah.
And we're comfortable moving forward. And then we're going to ask them, hey, now we need to get all the rest of the documents to us so we can, you know, really stand behind you while you're in your option period, so we
Right.
can validate that we can perform and close you on time.
As opposed to just looking at the information, taking their word of mouth, and saying, okay, you're pre-approved for this amount because you said you want that amount.
Right.
And you go out shopping, and then, so in other words, it's really important to meet with the loan officer.
Absolutely.
Go through an application process before you start really making offers.
I highly recommend that
Yeah.
because it gives us an opportunity to really support you. And, you know, let's say there is a home, and like I said earlier, there are some multiple offer situations still happening.
Yeah.
The right house, the right location, priced right, will still move quickly. And so by having everything in hand with the lender, then it's easy for me to call the listing agent
Yeah.
and edify the buyer
Right.
and tell the listing agent, hey, Mr. and Mrs. Listing agent, I've got a client here, Mr. and Mrs. Jones, and they're being represented by Dario Mambo, and I've got a complete file. Just want to let you know that if I were the home seller, and I'm not,
Yeah.
but if I were, I feel very comfortable and confident to take their offer, and we can close the next days. That's what they want to hear, right?
Yeah. Right.
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 Yeah.
And everybody has a better experience.
Yeah, absolutely. Because the worst case scenario is, you know, they get an offer, it gets accepted, they go through the option period, then they go through underwriting, the appraisal comes back fine, but then they find out that the income they actually reported wasn't true, or that there's judgments on their credit report they didn't know, there's back payments of child support that's changes the debt to something that happens.
It's happened. I've seen it all.
You know,
Well, I think I've seen it all, but I'm sure today I'll be surprised.
Yeah. So, why do you think some people hesitate to maybe talk to a loan officer before they start shopping for homes? Because most people don't understand that. You know, they're on Zillow, they want to see a house, they click, I'm interested. A random agent calls them. Sometimes it's me. That's scheduled to see a home. A lot of times when I ask them about the application process or the qualification process, or talking to a mortgage specialist about like what can you afford, there's always resistance because all they want to see is that home, right? So what is the misconception there?
Well, consumers in general are funny about their money. You know, when I visit with a client,
Yeah.
my goal is to connect with them on somewhat of a cellular level. So I
Right.
can let them know that I really want to help them.
Right.
The best comparison, the best analogy I can give you is, let's say I'm a doctor, and I'm not, right?
Right.
And you come to see me for help, and you want me to help, diagnose you and give a recommendation for treatment for whatever it is that you have going on.
Yeah.
So, but if I don't have consultation with that patient, then that's malpractice.
Right.
Right?
Yeah.
So when I put it in those terms and let them know that, hey, this is why I need to know this, and this is why I'm going to ask for this documentation, because I want to take great care of you. And so
You want to give them the
that
best prescription.
The best prescription for what it is that you can do, because there's, various different loans and products out there that you may fit into, and I just can't tell you what I think, what you should do, and or make suggestions.
Yeah.
And when it comes to, presenting a mortgage option to a client, I like to give them one, maybe two options, three at the most, but one or two. I'll lead with my top one, and
nice. And they can see the pros and cons of each option.
Right. I make suggestions, and the client will make the decision.
Yes. So I have a question for you. What is, and this is kind of a general question, but just give me your thoughts. What is the main reason why people, or like this is a scenario, someone's ready to buy a home, right? They see a house they like. When should someone start the application process or start the conversation with the loan officer when they see the house they like, they want to make a move, or when they're about to graduate college and they know they're going to have a good job for 2 years and they want to prepare? Like, when is the right time for a potential home buyer to start that process?
Well, the home buyer, when they have, I think these two things, okay? They have to have willingness, the desire to buy a home, right? And the second thing is capacity. Can they buy a home, right? And if they don't have capacity, but they want to buy a home, they should have that discussion early on so they can make, plans and prepare for when that time comes that they can move forward and buy a home.
You said willingness and capacity. So you talk to someone and they have the capacity, but like, oh, I'm only here because my wife wants to buy a house, or my husband wants to buy a house. Like I like where I'm at now. I don't need to buy a house.
Right.
You probably wouldn't push them.
No.
Right. Or vice versa. Like someone's like, they're really motivated. They live with family. They're growing family. They want to move to their own house. They're tired of living in an apartment. Right. They have the willingness, but they have inconsistent job history. They have incredibly high debt. They don't have the capacity, and so you probably wouldn't push them to buy a house, right?
Of course not, yeah.
In either case, you would probably make like a game plan,
sure,
right? Put them on a track and let them kind of pick their pace. Does that sound right? So what do we need to do as a loan officer, real estate professional? What do we need to do to change that misconception for people to meet with a loan officer before they start shopping for a home? Does that make sense?
Yeah, I think it's just we educate. We educate them on the process, but we educate the person who really wants to buy a home at some point, who really has that desire. Right?
So it can be 1 month, 1 year, 10 years.
It could be 2 years. It could be 3 years.
Yeah.
The client I mentioned earlier, we've been working on this for 2 years.
Yeah.
To get them to this point.
Good. Okay? Yeah.
And so, that was a unique situation, but. Yeah. It's never too early to start. But by that same token, the best time to buy a home was 5 years ago.
Right. Speaking of 5 years ago, I thought I was wanting to buy a home 5 years ago. Had to get my income and debt situated. Then when I was ready, I changed profession, career, and then no one told me how that would affect my ability to purchase a home. Then I had to wait 2 more years. And then what I was ready for ended up being like a long process. And this is why I advocate for someone to talk to maybe a professional like yourself, even before they're ready, in order to prepare a game plan. Because if I would have known what I know now, it wouldn't have took me 5 years,
Right.
I would have got there a lot sooner.
Sure.
And that's, at the end of the day, that's the game plan. I mean, that's the motivation we have to help people, to get them into their dream home, to help them from A to B.
Right.
So you have any what do you call it, like inspiring words for people who may be on the fence or maybe looking at real estate as a bystander and seeing, oh, what's going on is crazy? Like, what would you recommend for someone who's kind of on the sideline?
Oh, if you're on the sidelines, I've never met a first-time home buyer who said, I regret buying my first home.
Yeah.
I've never met that person. Okay? So those are my words of inspiration.
Nice.
Owning your own home, there's so many benefits. My own personal story, I bought a home when I was 20 years old. I stayed in it for 9 years.
You're 20 years old and you bought a home? Oh, my God. You're such a kid.
Yeah.
Wow, that's amazing.
Yeah. And so, but when I sold it, I made almost triple,
Wow.
my, profit from what I bought it at. So, and that took me and my family, my young family at the time, to a neighborhood, an area that I thought that I just dreamt of.
Oh, nice.
So
Yeah.
that was just a wonderful feeling, and I never lost that feeling of that zeal and that accomplishment, and I was so proud.
Yeah.
It was the best thing I did.
Nice.
Scared to death to do it,
Right.
but the payoff was huge.
Yeah.
It changed my life.
Nice.
And so home ownership does change your life, and it's something that everybody wants. And so, and for people who are renting and have concerns about interest rates, well, rent is 100% interest,
Oh my God, that's true.
right?
Right.
And so,
In what way? Can you explain that a little bit more?
well, you're never getting that money back, and when you get out of your lease, you're not taking anything with you.
So when you're paying a mortgage, you're paying, let's say in the first a few years, you're paying like 90% interest, 10% in equity into equity. So over time, it kind of balances it out. At the end of the term, you're paying 90% equity, 10% interest, right? So there's that balance there.
Yeah, principal and interest, right?
Principal and interest.
But the money that you're really going to make, right, is when you sell.
Yeah.
It's a profit you get from appreciation.
Because you've been buying into it.
Yeah, absolutely.
And if you're renting,
Right.
you're not buying into it.
Right.
You're paying someone else's mortgage.
Right, exactly.
Yeah.
So that's important too, because people think that, well, I'm making this payment. You're making a payment, but you're investing in yourself.
Yeah.
And then we also have tax benefits of home ownership.
Right.
You can tax deduct a portion of the interest you pay on your mortgage, property taxes. So there's a lot of benefits in it. And again, I've never met a first-time home buyer that said, I should have never bought this house.
Yeah.
Because
Right.
when they sell it and they take away a little pile of money, and in most cases, there's no capital gains taxes.
Yeah.
You have to fit a certain criteria to do that. They take that and they move to their trophy home or a step up.
Yeah.
They
Right.
realize it was all made possible by taking that first step and buying a home.
Right. Absolutely. Let's say we meet with someone and says, I can't afford to buy a home. I'm not making the income. My debt's fine. My credit score's fine. I just don't make enough income to buy a home, to afford a home today. Perfect. Let's talk about how you can make more money, how you can maybe start a side business, how you can maybe get a job promotion. Let's improve the quality of your life.
Right.
And on the way to do that, then you can afford to buy a home. Vice versa. Let's say you make good money, you have good debt, and you're gonna get into a home that's scary. It's like, I'm used to paying $1,500 in rent. Now I'm gonna pay like $3,500. I can afford it, but I don't know if I want to pay that. Well, by making that transition, you can afford it on paper, and you looked at your finances, you're fine. You're gonna have to make the lifestyle adjustments in order to fit that into your life. Which most of the times, you cut down on reckless spending, maybe make better investment decisions. So
Right.
either way, it's a good improvement in your quality of life. Would you agree?
I 100% agree. I sent a text to my son the other day, and tried to send him motivational stuff throughout the day, and I said, we vote for our future where we spend our time and where we spend our money. That's where we cast our vote.
Yeah.
And so back to a comment you
Nice.
made about where people can cut back. When I see bank statements from a particular buyer, and this comes up every now and again, and when they ask, well, I'm not sure if I can, afford this home payment, and they, like you said, they do make the income, their ratio's fine, scores are fine, and so I'll ask permission. Is it okay if I give you some advice that I would tell myself in your shoes 25 years ago, 30 years ago? And they always say, sure. Okay. I suggest, well, as an exercise, go through your last 60 days, maybe 90 days if you're bold in your bank statements, and highlight everything that you didn't need or can't remember.
Yeah. Right.
And so what they'll discover is, wow, I just highlighted my down payment money
Yeah.
that I just spent.
Wow.
On whatever, And so that really turns on a little light that they didn't think about before. they can actually afford to do this.
Right.
You know, it's their behavior
Clarity.
and how they clarity.
Yeah.
It's their spending patterns and their spending behaviors and what they can change or augment to live in the home that they really want.
Yeah.
And once they see that, the trade-off then becomes no argument.
Right. Right.
It's just logical, and they realize I really can't have this
And
house.
I feel like everyone should go through this exercise.
Yes.
Yeah.
Absolutely. Yes. If you're a first-time home buyer or thinking about moving up, and do
Nice,
that every now and again. Go through your last 2 months, 3 months bank statements, highlight what you don't remember or what you didn't need, and you're going to see a lot of opportunity there to really afford the home that you want.
Wow.
Or make a move.
Really good tip. Really great tip. Last question. You're self-employed, right?
Yeah.
Yeah.
I would call myself an entrepreneur.
Entrepreneur.
Right.
Do you have a team? Do you work for a company? Do you own your own company?
I don't own my own company. You know, there's owners in the mortgage business of a company, and there's loan originators. I love loan originating. It's all I want to do.
Nice.
And so I have a team, and I
Nice.
have great support, and they
Nice.
make my world go round, and I love them.
That's amazing. Let's say, how long you been in this industry?
Gosh, if I'm going to round up, let's just say 25 years.
25
Yeah.
years. In 25 years, like, what can you sum up some of the values you've learned in working in this industry as let's call you entrepreneur, because, no one pays you to work. You have to earn to work.
Oh, yeah. So some of the values I've learned is two of them. And one of them is, and I'm going to have to credit a book that I picked up. It's called Principles by Ray Dalio.
Oh, it's like this big.
Yeah. Get the audio. It's more enjoyable.
There's also an app for that.
Yeah, he has an app for that, yeah. But to be radically open-minded and radically transparent. Okay?
Nice.
So that's the wisdom and the values, to use your word. Do that. And I think over time, you're just going to, open yourself up to other opportunities.
Nice.
And to help people the way that they really need help from a loan officer or a realtor. Just be radically open-minded and radically transparent, and it's magic.
Nice. Well, with that being said, I'm going to end it right there. That's a perfect way to end it. Thank you, Cleo, for coming on.
Thanks for having me.
Yes, till next time.
Next time.
Sheesh.